How can someone who does not have $1 million saved up achieve living off dividends? That's $1 million question, isn't it? The financial media has convinced you that living off dividends is impossible unless you're already rich. They've told you that you need $3 to $5 million saved up to even consider it. They're wrong, and I'm going to prove it to you right now. Before we dive in, I want to be clear. This isn't a video where I'll list individual stocks with high yields. If you came for stock picks, this isn't that video. Instead, I'm going to show you a forgotten path to dividend freedom that most financial experts never talk about. The average American retires with less than $200,000 saved up. If you follow conventional wisdom and bought S&P 500 dividend stocks yielding 1.2%, you would make an embarrassing $2,400 a year. That's $200 a month. You can't even pay rent with that. But here's what Wall Street doesn't want you to know. There's an entire universe of investments paying 8%, 9%, even 12% yields that almost nobody talks about. These aren't risky penny stocks. They are established investments with decades-long track records that have survived multiple market crashes. In this video, I'll show you exactly how to generate $40,000, $50,000, even $60,000 a year in passive dividend income with a fraction of what financial advisors tell you need. And if you don't take advantage of this, you'll be stuck selling your precious shares during every market crash for the rest of your life. Let's be brutally honest about today's stock market. The average S&P 500 stock pays a pathetic 1.2% dividend yield. That's an all-time low. Do the math. To make just $40,000 a year from these traditional dividend stocks, you need $3,333,333 invested. Over $3 million just to earn less than the median American income. But here's what they don't tell you. This wasn't always the case. For 140 years, the average S&P 500 yield was 4.2%, more than 3 times higher than today. During the 70s and 80s, yields regularly exceeded 6%. So what happened? 2 things. First, companies stopped prioritizing dividends to chase share buybacks and growth at all costs. Second, the market has been pushed to astronomical valuations, driving yields to the floor. And if you think this 1.2% yield environment is temporary, you're dreaming. With technology companies dominating the market and inflation still higher than historical norms, yields aren't magically going back to 4 to 6% anytime soon. I'm not here to sugarcoat this like other finance channels. If you're trying to live off traditional 1 to 2% dividend stocks, it is practically impossible unless you've already got millions saved up. That's why so many investors give up and throw their money into index funds or growth stocks instead. But this creates an even bigger problem that most people never see until it's too late. Most retirement strategies are built on a dangerous lie that you can safely sell 4% of your portfolio every year to live on. Financial advisors call this the 4% rule. What they don't tell you is that it fails catastrophically during market crashes. Let's look at what happened to retirees who used this strategy. During the 2000 to 2002 crash, the S&P 500 collapsed 45%. If you retire right before this with $1 million and were selling shares to cover expenses, by 2003 your portfolio was down to $550,000. Even as the market eventually recovered, your wealth never did because you sold so many shares at rock-bottom prices. The 2008 financial crisis? Even worse. The market dropped 57% from peak to trough. Many retirees lost over 60% of their life savings and were forced to go back to work in their 70s. And don't be fooled by the bull market we've had recently. The S&P 500 has had an average intra-year drop of 14% for nearly 100 years. Every 4 to 5 years, we get a 20% plus crash. It's not a question of if, but a question of when. Now imagine you're retired during one of these periods, forced to sell your precious shares every month just to buy groceries and pay your mortgage. You're selling at rock-bottom prices, permanently destroying your nest egg. This is a selling shares death spiral, and it's devastating. You sell more shares when prices fall. Those shares never recover with the market. Your income potential is permanently reduced. You're forced to sell even more shares next time. With dividend investing, market crashes become an annoyance rather than a catastrophe. Your income stream continues flowing regardless of what happens to share prices. But this brings us back to our fundamental problem. How can you generate enough dividend income without needing millions in the first place? Here's the exact math on how much capital you need to generate $50,000 in annual dividend income. At a 1% yield, you need $5 million invested. At a 2% dividend yield, you need $2.5 million. At a 5% yield, you need $1 million. At an 8% dividend yield, you need just $625,000. At a 9% yield, you need only $556,000. And at a 12% dividend yield, you need just $417,000. See how dramatically that changes things? At higher yields, the impossible suddenly becomes achievable. Now I know what you're thinking. Higher yields mean higher risk. That's what Wall Street wants you to believe. But here's the truth they don't tell you. There's an entire universe of investments that consistently yield 8%, 9%, even 12% or more with solid track records spanning decades. These alternative income investments rarely get coverage on CNBC or Bloomberg, yet they're hiding in plain sight. Number 1, closed-end funds. CFC's funds use strategic leverage to boost yields. Many pay monthly dividends of 8 to 10% and have done so reliably for 20-plus years through multiple recessions. Number 2, business development companies. BDCs finance growing businesses and pass the income to shareholders. Top BDCs like Main and ARCC have paid consistent 7 to 9% yields for over a decade. Number 3, covered call ETFs. Funds like JEPI and XYLD generate 8 to 12% yields by selling options against their portfolios, a strategy previously only available to wealthy investors. Finally, mortgage REITs. Companies like NLY manage mortgage portfolios and can yield over 10% annually. The financial media hardly mentions these because they're not exciting tech stocks or index funds. They don't fit the conventional wisdom that high yields must equal high risk. Don't believe me? Let me show you the actual track record of some of these investments during market crashes. During the 2008 financial crisis, PIMCO's PTY fund continued paying its dividend without interruption. In the 2020 COVID crash, most BDCs maintained their distributions despite the market falling 34%. Many of these funds have maintained or increased their payouts for 15-plus years straight. The power of these high-yield investments becomes clear when you look at real numbers. Let me show you a real example using PTY, the PIMCO Corporate and Income Opportunity Fund. This closed-end fund pays over 10% yearly, distributes monthly, and has done so through 3 market crashes. Not a single dividend cut during the 2008 financial meltdown. Not one. Skip the small examples. Let's go straight to what matters. Invest $1,000 monthly into these high-yield investments for 15 years. That's $180,000 total invested. Result? You're making $29,700 every single year in pure dividend income. That's $2,475 flowing into your account every month, whether you work or not, whether the market crashes or not. Compare that to conventional advice, which additional 1.2% dividend stocks. You'd need over $2.4 million to generate the same income. Which approach sounds better to you? And here's what nobody else will tell you. During market crashes, these high-yield investments often go on sale. While everyone else is panicking, you're collecting bigger dividend checks and buy more shares at discount prices. This is how ordinary people are achieving dividend freedom without needing millions. They're using higher-yielding investments that most financial advisors never mention. And the best part? You never have to sell a single share, even during market crashes. In fact, Market crashes become buying opportunities because your dividend income lets you buy more shares when prices are low. Here's the strategy most wealthy dividend investors use to accelerate their path to financial freedom, and it's surprisingly simple. First, forget what you've been told. Dump the low-yield garbage. Fill your portfolio with 9 to 12% yielding assets that pay you now, not someday. Second, use the dividend doubling technique. Combine high-yield investments that pay you today with dividend growth stocks that increase payouts 8 to 10% annually. This creates an income snowball that most investors miss completely. Third, become a dividend machine. Set up automatic investments. Set up automatic dividend reinvestment. Then get out of your own way. The system works without you touching it. The secret weapon? Tax-free dividend growth. Building this in Roth IRAs means the government never touches a penny of your dividend income. They can't tax what they can't see. If you're serious about achieving dividend freedom, here's your exact action plan. First, stop chasing low-yield index funds and popular tech stocks if your goal is income. They're great for growth, but terrible for generating cash flow now. Second, start building your dividend portfolio immediately, even if you're starting small. Begin with just one high-quality, high-yield investment. Third, create a systematic investment plan. Decide exactly how much you'll invest each month and stick to it religiously, regardless of what the market is doing. Fourth, track your progress obsessively. Monitor your monthly dividend income and celebrate every milestone. This keeps you motivated on the journey. And finally, continue educating yourself about these alternative income investments. The financial media won't cover them, but that's exactly why they work so well. Most investors don't know about them. Before we end the video, here's the conclusion. Living off dividends isn't just a dream reserved for the wealthy elite. It's an achievable reality for ordinary investors who know where to look. Will it happen overnight? Of course not. Will it require consistency and patience? Absolutely. But the math doesn't lie. Generating $40,000, $50,000, or even $60,000 in annual dividend income is achievable with far less capital than most people think. If you want to learn more about these higher-yielding investments that can accelerate your path to dividend freedom, hit that subscribe button. This channel is dedicated to uncovering and explaining these alternative income vehicles that can secure your financial independence. Thank you for watching, and until next time, take care